Good evening, everybody. Nice to hear from you. Yes, I believe in loving my life. So I hope you will do the same as well, because if your life is worth living for, then it is worth planning for life. That's my sole belief. And FinEd SG with Xian is financial education in Singapore. So the special series is COVID-19, of course. And episode 5, we have a case study for private banking clients. So let's begin, my friends. Hello, so this is me. I'm Xian. Everybody knows me as Xian, and I'm in the business of investment risk management. And I've been a client of Unicorn for 5 years, and I was really lucky to be gaining the financial wisdom from Unicorn, and also as a 25-year-old, not too young, not too old, with $25,000 as assets, and then it grew to almost 200,000 in 5 years. So that's the result I witnessed from Unicorn that gave me a motivation to really do more, expound from myself, to provide for beyond myself to my family, both my parents, and then to my loved ones, and also my friends. I feel that this is the business that I can do to really help, or at least serve a lot of people in my life. So that's why I'm in this business. Okay, so welcome. My personal mission, I will share with you probably in the next chapter. But yes, let's carry on. All right, so in this educational series, COVID-19 specials, we had this in the early part of May, and understanding the circuit breaker is over, but yet there's still a lot of us working from home. So I will have this weekly 35 minutes to keep you guys abreast of this information and this knowledge on economy updates, market updates, and also case studies that my investment committee research team has already done a lot of good research to allow me to share this with you very confidently. What is it now in the situation? And of course, I will share a little bit about what is next. And this episode, we have a small bonus, but always only in selected series. So disclaimer, just this slide alone, just to help you understand, it's always for information only. It's always on knowledge, and nothing that is an advice over here. If you need further advice, definitely can come to me. As you can see, I already have a license for it. So before we start proper, I always like to have us ponder on some things. The first thing to do is to share with you, when we don't know the reason behind why we do things, the things that we do will never become ours. Okay, this is something that really resonates with me, because as long as we don't know why, actually a lot of things that we do will not become ours eventually. So as of today, as you take in the information today, how do you make it become yours? I'll first start with something for you to ponder about. So we look at speakers, right? This is from Bang & Olufsen, yeah, a European company. And you take a look at the price. It's about $20,000 speakers for your home. So let's say you bought this 20,000, okay, in Sing dollars, close to 20,000, right? Dollars speakers, and you have it for your home. There are three things that you can do, three options that you can set it up with. First, you hire an expert to set it up. Second, you follow the manual and you try to set it up. Or third, you just set it up without thinking or without looking through anything. You just go ahead with it. So my friends, I give you about 10 seconds to ponder. Which option would you choose? You're welcome to also share with me on a group chat. No, sorry, not group chat, this chat, this Zoom chat. Okay, guys, I feel that you already have an option for yourself. So if you have chosen the first option, hire an expert, which is something that I will also do so, simply because it costs $20,000. It's not like a Bluetooth speaker that is less than $100 that I can just anyhow set it up without even looking at the manual. So this is what I won't do. Maybe Those of you who chose to choose the manual and then try to set it up yourself, we'll be happy to hear more from you lah. If you can text me and tell me what are your answers. But basically, I just want to share with you that those who actually want to do it themselves will probably be, they are already the experts of setting up this Bluetooth or these speakers from home. Normally, they are the technicians themselves, or they are the experts. They know how to do it. Because who would risk spoiling a $20,000 speakers for their house? So same thing as you ponder about your assets and what is the reason why you invest, then I hope you can understand from this analogy how you would like to go on with this. Go on with all the information that you're receiving. And just to share with you, nothing wrong to do it yourself. You just need to know how much it may cost you, the risk of it. Okay? All right, so we start the session proper with economy update first. Won't be much. Previously, it was this non-stop printing from the Fed government. And then we were talking about the fact that it's going on to round 2. We are still on a horizontal movement. So this was what I was going for. We had 3 scenarios that we wanted to talk about since the last episode. So let's go in straight. How will it look like? First, the resurgence of COVID-19 virus with the reopening of economies, which I will go deeper in with the slides later. Then there is a slow recovery of consumption and the business spendings. And some industries will be permanently affected. So these are the round 2s that we might be looking at. The first one, the resurgence of COVID-19 virus with reopening of economies. I think as we are very keeping abreast with all the news that is happening around the world, because almost every single news is telling us the same thing now. South Korea, Germany, and there are other countries that try to open up, including the US, talks about the new outbreaks. So this is where you actually have to be prepared that there is a chance for us to go into a next lockdown. Because every time there is a chance, there is an increase in the outbreaks, the thing we need to do is go back to square one. This is something that we always have to ponder. So the restaurants, the companies that were really dependent on businesses, they are slowly finishing their savings. You know, they're getting poorer and poorer in this situation. And same for some of us here, that we are only having expenses that are running. We're still having to eat and having to move about. So we are getting poorer and poorer if there's a next lockdown. There is a situation that we're getting close to solvency crisis. So in the previous first 2 episodes, even the 3rd episode, I actually highlighted about the 2 types between liquidity crisis and solvency crisis. So yeah, go watch the recap if you need to. All right, so in the US, we talk about US a lot because it has the biggest economy on us, impact. So end of 2020, is it a realistic time frame? Because Trump is really, really concerned about opening the US again. Simply because, as what Bill Clinton used to say, well, actually, whether you get re-elected as a president is not as complex as you think. If you are in the economy that is doing well, you probably get re-elected. But if you're in an economy that actually slumps, then say goodbye to your presidency. So that is the risk that Trump is facing. And that's why he's so eager to reopen the US. Even the top medical advisor, Dr. Anthony Fauci, has already mentioned if there is actually a vaccine, it actually is going to take 1 year for it to really have a vaccine for everybody, including the US. Of course, US will start to have it first. So there are only 2 things that can really help us to go back to where the economy was. The first thing is definitely when the vaccine is found and the dosage is given to the entire world. That is definitely something that needs to be done so that people will feel safe to head out. The second scenario is when it's a bit like Singapore, you know, they are able to test everyone and figure out who has COVID-19 and who doesn't. Then it's safe for those who go on the streets to understand that, oh, all these people on the streets are not having COVID-19. So these are the two scenarios that we can believe that we can go back to the normal times. And I don't believe this is an easy scenario to go towards. Okay, in the absence of these two, the economy recovery will be very, very slow. Just imagine the situation in Singapore for yourself. If the government says, hey, you are actually free to go and watch a movie and go and catch up with your friends with all the beers and all the drinking sessions that you can go for, how many of you will actually love to just go for it? If you go for the movie just when the economy reopens, do you believe that the movie theater will be full house? Or the beer bars will also be very full? In my own perspective, I believe this will be, people will take caution. It will not be so easy for them to just release themselves even when the government says it's okay. Okay, so these are the things that I can imagine. So this is why it's leading to this part B here. Well, the Feds have already shared, Mr. Jerome Powell, that it will definitely try to deploy its tools to the fullest to avoid these outcomes. The outcome that we're talking about is the solvency crisis. So we talk about non-stop printing of money. And in the previous episode, we also talk about what kind of impact there is to printing of money. So, but what is actually more important to take note here is that the rebound can be fairly quick and robust, but it's the shift that reflects the deep job and economic losses that the pandemic has already inflicted. So this is why the recovery will be a lot slower, because the damage is already done. It has started. So this is the reality that we have to face. And in the first place, there was never a big growth in the last 10 years. So with this COVID-19, it even reverses. The third one, some industries will permanently be affected. So 5 to 10% of it will never live to see the days. Okay, live to see the daylight lah. So because of these key points here, prolonged quarantines may alter the consumer behavior in ways that they won't be reserved. My dear friend and client also shared with me. So talking about gyms, she also helped me to understand, hey, actually, after working from home, right, I started to do my own home exercise and realized that I don't need to actually go to the gym to keep myself disciplined. So this is one simple change that she has gone into, and that helps her to reduce her expenses. Very logical, very sensible. And this is probably permanent because if it translates to everybody, then obviously the gyms will start to not have any business. So the effects on consumer behavior will be determined by the length of at-home stays and will differ from industry to industry, of course. Will a lot of people actually enjoy spending 22 hours, 24 hours flight to get to US just to have a meeting and come back straight afterwards? Maybe the first few times is fresh, where you get to go to New York and see things. But if this is a consistent way of traveling just to have a few meetings and come back, then this new environment actually helps them to understand, not just on the monetary savings that they get, but also the time that they save. 24 hours flight or 12, at least 15 hours flight to Europe. So this is also a permanent change. Then how is it affecting us in terms of financial markets? So this is not new from last week. We're understanding that now we are going on a flat line, on a horizontal line. Everybody is waiting for either round 2 or nothing happens. Then I would like to take a poll after having shared with you the scenarios that are happening. How would you actually invest given in such an environment? Okay. So I launched the poll now. And let me know, what are your options? Will you keep 100% cash and wait for things till they are clearer? Or you stay half invested, half with investments? 100% into equities? Or other variations? Thank you very much for your participation, guys. I'll give another 5 seconds. Okay, so thank you very much. About 50% of you actually talk about having number two, half invested and also half having savings, which is which is the portfolio that we are also having in Unicorn in our stance, about 40 to 50% cash and gold and 50% equities. So previously we talked about how we differentiate the 4 types of businesses in terms of growth, dividend yield, and risk. And I promised to share about this because we talk about the 4 types of businesses a lot in our first 3 chapters. That's how we actually see the companies falling into one of these categories. And the interesting part is that they might change type according to the environment, because now it's highly disruptive. Any technology can just switch them over from, let's say, a cyclical growth to a mature and stable, or even structural losers. So the information on growth, you already know how it is. Cyclical growth, it really depends on the economy. Okay, then mature and stable is generally slow. So later I can highlight to you what it means to all this. Then structural losers are the negative growth people. Without the economy, good or bad, they already lost market share. Structural winners are the ones that are very fast because they are the disruptors. So what about dividend yield and risk? Dividend yield can be like this. It varies, but likely to be cut during poor economy times. So when I shared with you about DBS, this was likely the situation. Perhaps not DBS, but a lot other banks, they are doing not as well as DBS. At least DBS hit the peak, right, in 2007. The price of the stock went back to the peak of 2007. The rest actually went below the lowest point in 2009 during the last crisis. Like things like banks like HSBC and Standard Chartered. So it really varies how they would like to give you a dividend yield. So if you are an investor yourself and you're looking for a dividend yield companies, this is something that you might want to avoid. Then mature and stable, at the moment is high and stable, but it really highly depends on whether it will be disrupted in the future. Because after that, you know, they will move around in terms of category. Structural losers, high but reducing. If you can liken it to something, would be StarHub. They used to be also borrowing money from the bank to actually pay dividends. But what happens to that? Cash flow issue. So structural winners at the moment, they are low, but they are growing. Okay. In terms of risk means it's prolonged, for cyclical growth, prolonged slow economic growth that would be detrimental, tend to be very volatile during an economic downturn. So definitely slow economic growth because of the horizontal line that I talked about, and this sailboat without the engine. So these are the icons that you can recall. Why is it volatile? Mature and stable, like I mentioned, could be structural losers if their business is disrupted. So as you take a look at the quantitative analysis of these companies, you can also understand how is their future in the business like. And that's the profit driver. That's what we shared last week, right? Structural losers are the value traps. For example, now the very obvious one would be Singapore Airlines, where it could be a value trap. It's very cheap now and even relatively close to their historical share prices, the lowest. But what happens, like I mentioned to you, if there is a permanent change in people's mindset, just like habits, right? They are actually very, very hard to change, very hard to break. But in this environment, we are all forced to use Zoom. Who's having meetings so freely outside now? And even people who were never likened to online environments have to use it. So this is the difference now. And that becomes a value trap if you don't take a look at their future of the businesses. And for structural winners, such stocks are normally coming at very high valuation. So this is where there is actually there is a discussion on Mr. Warren Buffett's philosophy on this, because it used to be the margin of safety, right? So this is the term that is debatable at this point in time. The philosophy still holds very still. It's just that now stocks that are really good are coming at high valuation, and that affects the analysis for the margin of safety. So share price could be punished if the growth actually slows. But generally, structural winners, as I can give you a tip, is that they're looking at growth at 10% per annum. Then that's what we categorize as structural winners. Okay, so we move on to the case study at this point. Private banking client. So this is a real case that I would like to share with you what it is for private banking client. Private banking client is above the premier banking. As you can see, when we all go, let's say for OCBC and NEXT, right, we can see quite a big bank of OCBC over there at the basement. Then there is another portion that talks about premier banking. So private banking is above that we really talk about 6 figures and above in terms of investments. So this is the client background. He's doing very well in his career. So he decided to work with a private banker, one with a global bank and one with a local bank. So 2 portfolios. Actually, this is this really shows his status, his financial status, because it's 6 figures each month. So the portfolio as of 31st March 2020, he actually lost 60% of the net value in total already. So that's when the client actually asked for help from Unicorn to one of our consultants to actually help him. And this is obviously not a normal consultant. He's actually the head of our investment research. So yeah, only he has the capability at this time. So what does the portfolio entail? So 50% of them are actually equities, right? Then equities we don't need to talk about, is the stocks and shares that we always share. Bonds and perpetuals are actually at 22%. So this is something I can help you to really a little bit deeper, because now we are quite content heavy, right? If you open a char kway teow store, and then because of a good recipe from your parents, okay, but you only have 600K at this point in time, and then you need $1 million to start your business. Okay, so you need to borrow from the bank another 400K, right? So 600K is something like your equities, because you own them and it belongs to you. Then you are borrowing from a bank, right? So it becomes a bond, something that you need to repay back. So how does it work in the economy? Then let's say if your business is doing very well, then the bank loan that you give back to this 400K bank loan, right, to the bank, has no effect, because you do well or not, you still have to pay the same interest, right? So the business doing good is very good for equities. Then whatever excess in profits belongs to the equity owners. So this is good. But the reverse is also the same. When you're not doing well in your equities, the bonds you still have to repay by the interest rates. So whatever you owe the bank, you still have to pay the interest rates. Your business, good or bad, still need to pay. So as an equity owner, you will actually lose the 600K first before you lose the 400K. Okay, so this is probably something easier for you to understand. And the rest, I wouldn't say much goal. It's quite obvious. It's quite a good inverse relationship. So inverse ETFs is something interesting, because this actually, if you look into detail, is inverse of the equities. So if the equities are doing well, like up 3%, the ETFs, this dark blue one, will be down by 3%. So basically, they are just neutralizing each other. And we actually found it strange that they're in the same portfolio. So in that sense, you can imagine the equities as a striker, and then the rest of the products, structured products, we will leave it for another chapter. But yeah, but the other side is defensive. So in terms of equities, as we look deeper, quite a lot of them are in Singapore, then US just a little bit, and then China internet companies. Okay, so we try to look at what was the performance. So as I mentioned just now, the client came to us and it was already from -5 to -45. from all the things that he has in his portfolio lah. And just to share with you, this is the bonus part. In our portfolio for stocks and shares, there's only one, we have at least like 15 counters to 20 counters, that means companies, that are actually doing on a plus. Looking at real time in terms of 31st March, this is already up to May. So there's only one counter that is not doing well. And I call this a bonus because you can actually take a look at all these counters and see what are these structural growths that we're talking about. Because in Unicorn, right, we are actually looking for investments and the right counters and the products to create wealth. Our intention was never to diversify. It was literally to find companies that are structural winners so that we can help ourselves, help our clients to create wealth. Salespeople actually teach people what they say, but in Unicorn, we actually share what we do. So whatever we recommend to you is something that we have invested to. So if you can imagine, it's like a fellow friend who has already invested and sharing some good feedback with you and help you to understand whether you enjoy the philosophy that we have so that we can also make money together. Because the intention here is to grow wealth, not diversify for the sake of diversification. Lots of people have portfolios from different regions, different sectors. But if you just take a further look or even just ask the question, actually, what is your investment philosophy? And allow them to share with you where they are coming from, I believe your why gets very strong. Why are you investing? Okay? So coming back to this, just want to play a football game with you. For the next 10 years, we're actually looking at very slow growth, even slower than the last 10 years. Because China's growth story has already passed. Okay, and US and the European companies, we don't even need to talk about them. They are already close to zero or minus interest rates. So talking about this, we will look at, let's say, the mature and stable. If you guys like football or soccer, you will understand this. When we talk about mature and stable companies, they are actually the, okay, not very strong, but also not very weak team players. So in, let's say, a Super League, they are actually the ones that are ranked in the middle. So they win some, they lose some. So if in terms of the environment that is very slow, okay, then you can't really do much with them. So you probably don't win the league, but neither do you go on the last place. For cyclical growth, then we can talk about people who are always dependent on whether they are on form that day. Okay, so if you're a team sports player, you will understand if you're on form, then you probably like play very well and win the match. But if you're off form, same player, but just off form, then they will also lose the match because they just simply cannot score or simply cannot defend on that day. That is cyclical growth. Structural losers, as you can understand, it could be always the same field that has ended up in the last places of the league scoreboard. And structural winners, they are not just the disruptors, I must share with you. They're not just like Uber and Tesla, where they can score, but they also lose a lot. So you can score a lot, but if you score 3 goals and you let in 4 goals, you still lose. So structural winners is not just about being disruptive. It's also about being defensive. So if they're able to defend very well and yet score a lot of goals, so these are the companies that we're looking for. Okay, last bit. Content heavy again, so thank you for staying with me. 2 things. Coming back, how would you like to really outshine your current financial position? As I shared with you, it's always about asking why, what is your intention? Because picking up information after information, if I were you, I would also be very concerned about the time I use to look through all the webinars that are happening. It's really, really noisy world out there. But if you take a further note about your own finances and understand how would you like to outshine your current financial position, then this is a place where we can really converse deeply. I shared this a few times, actually many times, talking about setting aside proper asset allocation. First, you set a contingency, economic life value risk management planning. What could derail you from your financial objectives, from achieving it? Then last part about own savings and investments. And that's where we really talk about investments. But the question is over here. Many a times I hear my friends and clients tell me, oh, I already know what it is. You're just telling me what's my current position and what's the future I want to get into, then the gap, then we'll fill in the gap, right? Yeah, sounds very logical. Of course, this is something that maybe even computer can do or a lot of people can do. But what's more important is really understanding the inner world of that person. Everyone is different. What does it mean to have the lifestyle during financial independence? And are you able to take what is suitable for you in terms of the instruments? Do you believe it's all the same, that we are all cookie cutters, that we're able to withstand the emotional ride across this high volatile environment? And how are you going to make such decisions if you want to really space out this asset allocation? So I want to go deeper into this. What you will get as a client. First is the financial education, which I've been really, really heavy on this, and I will continue to do so because it's really my pleasure and my duty to share with my loved ones and my friends about what is happening and what they can really do and speak to. So financial education is always the base. This is where you can really gain the wisdom and help yourself to understand whether to make a decision on the things that you need to do with your life. It involves your life. So the second part where we go in is financial coaching. Financial coaching is where it's a personalized coaching session, financial planning process, where we really understand you very deeply, where we have fun and talk about your dreams and your aspirations and how we can get there, and then work in detail together and spend the next 20 to 30 years looking forward to really achieving it. Third is financial planning, where we really start to build the blueprint for yourself and help yourself to be committed towards it. Last but not least is the management. For 20 to 30 years, even I, for example, driving in a car, is actually, you still need quite a few mirrors to check on the blind spots that you may have. And even then, you still don't get to see some of the blind spots. So financial management is a way for us to really go through and help you monitor on the blind spots. All right, these are the 8 services that I always share. But most importantly, as we are opening up and loosening the guidelines, we're able to meet soon when the F&B is open. Then we can talk deeper into these services, because these are really helpful to help you achieve your financial objectives. Okay, I won't go very deep because unfortunately we have already gone 35 minutes on this. So thank you for staying. But our unicorn strategy is always like what I mentioned, about 50% gold and cash not invested, but yet highly selective on the equities that we already invested in because of the divergence. Okay. Last but not least, I just want you to understand that when we don't know the reason behind why we do things, the things that we do will never become ours. So I hope you will take this with you. Next episode, we will always have the same things, economy updates and financial updates. But the most important one is we're going to talk about mature and stable companies. All right, so that is next Tuesday. And I love to share this with you always. Mr. Warren Buffett always share, you only have to do a few things right in your life so long as you don't do too many things wrong. I love this because we don't need to be geniuses in every field. So what I can do for you, advisory on cash flow management and budgeting, definitely. And advisory on asset allocation to optimize returns on your investments. Once again, it starts from why. Okay, so thank you very much, guys. The you can scan the QR code for registration of episode 6 for next week. If not, you can also look for me on a one-on-one session or just go deeper into the questions that you might have after listening to me. And then, yeah, we can figure it out together. What is it that you are actually looking for and be specific? If not, so thank you very much, guys. I will see you